Welcome to the FinTickAI Strategic Analysis on Indian IT versus AI. We will explore whether the current changes represent a structural reset or a secular reinvention. In this executive summary, we dive deep into the structural shift from labor-based arbitrage to efficiency driven by AI-native solutions. Indian IT is not experiencing a cyclical slowdown, but a structural reset. This shift is powered by enterprise-grade AI giants like Anthropic, OpenAI, Microsoft, and Google. Labor arbitrage is compressing. The old model, based on large pyramid workforces and T&M contracts, is giving way to new consultancy models like collaborative, continuous, and instant consulting. What is changing? In delivery scale, AI reduces the need for mass-scale junior coding. Contracting is shifting to outcome-based models. ADM cycles are shrinking by 40%. Generative AI tools enable 30 to 50% faster coding, drastically reducing human hours required for development and directly impacting revenue models based on headcount. L1 per liter 2 automation brings automated testing and ticket resolution. AI handles basic ticket resolution and bug hunting with near-perfect accuracy, reducing support requirements. Self-healing systems are emerging. This involves AI-driven infrastructure management, reducing downtime, and end-to-end automation of infrastructure support services. We now examine the direct financial consequences, specifically the impact on revenue, costs, and profitability. The core question from enterprise clients is clear. If AI improves productivity by 40%, why pay the same billing rate? We are seeing up to a 40% productivity gain, driven by improvements in quality, efficiency, speed, and cost, which impacts revenue per employee. Structural risks to billing and margins are identified. These include billing rate renegotiations across Tier 1 clients and margin compression risk from internal AI upskilling costs. The talent shift is characterized by shrinking junior hiring. Junior engineering roles are being displaced by AI-augmented seniors, causing a structural decline in campus recruitment. Client behavior is shifting. Discretionary IT budgets are cut for internal AI pilots. There is a demand for productivity pass-through and outcome-based pricing, and a reduction in legacy spend. Revenue growth is moderating. Historically, at 15 to 18%, growth is now projected at 8 to 12%, settling into a new structural reality. Our medium-term outlook for the next 2 to 5 years forecasts revenue moderation and significant workforce shifts. Workforce restructuring is transitioning from a pyramid structure to a diamond structure. Large junior bases are evolving into expert-heavy structures, focusing on high-value roles. Competition dynamics show a divide between agile AI-native firms and incumbent inertia. AI-native firms are capturing market share with high-margin AI offerings. Looking at the 5 to 10-year long-term outlook, we anticipate the commoditization of code and the rise of platform intellectual property. The final divergence shows 3 outcomes: premiumization of platforms and IP, AI-managed enterprise systems reducing maintenance, and the death of high-volume staff augmentation. The IT companies that survive this decade will be the ones that transition away from pure labor arbitrage and successfully pivot to selling scalable, repeatable software IP with massive margins. Welcome to Section 5, the management angle. We've established the AI threat, so the obvious question is, why aren't these IT giants moving faster? Here, we analyze the inertia, the governance structures, and how leadership is actually attempting to pivot. The answer comes down to large workforce inertia. Steering a ship with over 200,000 employees is incredibly slow. More importantly, there is massive internal conflict. If management deploys AI too aggressively today, it immediately reduces billable hours, which crashes their short-term revenue and profit targets. However, these legacy IT firms have a massive protective moat: governance. Heavily regulated industries like banking, financial services, and healthcare require trusted partners to manage their AI governance. Large enterprises will always prefer a slightly slower, risk-averse incumbent over a nimble startup when deploying mission-critical infrastructure. Section 6 dives into a macro factor that often gets ignored in tech analysis: geopolitical risk. We are currently navigating intense tech fragmentation, data localization laws, and strict sovereign cloud mandates. The US-China tech decoupling is fundamentally fracturing the global internet. Enterprises are now being forced into sovereign cloud setups, meaning data cannot leave specific borders. This drastically increases the compliance and operational costs for Indian IT vendors, who historically relied on borderless data flows. Data localization brings three massive headwinds. First, compliance. Regulatory oversight in EU and US markets is spiking. Second, data laws. Mandated local hosting means Indian IT firms must increase their capital expenditure. And third, visas. Tighter mobility restrictions mean firms can't just fly cheap Indian labor abroad, they are forced into expensive, localized hiring. It's not all bad news on the macro front. India's free trade agreements provide excellent leverage, acting as strong tailwinds for cross-border SaaS and digital services trade. The key supportive factor here is strong intellectual property protection across these corridors. Let's move to Section 7, Market Context. How is the stock market actually digesting this AI disruption? We are benchmarking the valuation repricing and sector-wide performance. The market is already pricing in the pain. We've seen an approximate 21% negative return in the sector over a one-year period, dropping from a 52-week high of around 41,600 down to roughly 30,900. The AI scare has severely compressed valuations. Finally, in Section 8, we conduct our company deep dives. This is the individual strategic analysis of the top 10 Indian IT firms to see who is actually positioned to survive. First up is TCS, the undisputed structural leader. With a market cap of around 10 lakh crores and an ROE of 55 to 65%, they are a likely long-term winner. Why? Because their enterprise penetration is so deep that ripping them out of a client's infrastructure is almost impossible. Infosys is executing what we call the AI-first pivot. They are aggressively shifting to generative AI through platform orientation. By addressing the revenue cannibalization risk early, they have largely mitigated the downside, maintaining a strong 32 to 38% ROE. HCL Tech offers a unique defensive play. They possess a strong engineering, research and development, or ER&D moat. This specific segment is harder for AI to displace immediately, providing a structural buffer that justifies their 23 to 27 XPE ratio. Wipro is currently a turnaround story. While they have ongoing AI initiatives, their success is heavily dependent on execution consistency, which has been a struggle. This is reflected in their lower ROE of 15 to 18%. LTI and Tech Mahindra are in transitional phases. LTI is expanding digital services but faces severe margin sensitivity. Tech Mahindra carries significant risk due to its heavy sector concentration in telecom automation. If you want growth, look at the mid-tiers. Persistent Systems is an emerging winner, driving digital native AI transformation with premium growth. Meanwhile, Oracle Financial Services, or OFSS, is a structural winner because it is product-led. Their high platform revenue insulates them from the service-level AI disruption. This brings us to the ultimate scorecard. We are benchmarking market cap, PE ratios, and return on equity. Let's rapid fire through the top tier of Indian IT to see exactly where they stand in this AI transition. The safe havens, TCS and HCL Tech. TCS is the heavyweight champion. Their advantage is deep enterprise penetration. They are so heavily embedded in global Fortune 500 infrastructure that ripping them out is practically impossible. HCL Tech is our other defensive pick. They are protected by a massive engineering, research and development, ER&D moat. AI can easily write code, but it cannot easily displace complex physical engineering research. The AI-first pivot, Infosys, is taking the threat head-on by executing an AI-first pivot. They are aggressively launching generative AI platforms, essentially willing to cannibalize their own legacy revenue today to secure platform dominance tomorrow and protect their elite 30% ROE. The mid-cap growth engine's Persistent and Coforge Persistent Systems is digital native. They sell AI-led data modernization without the heavy baggage of legacy maintenance contracts. Coforge is highly agile. They are winning specialized deals and adapting to AI client demands far faster than massive legacy firms. Both command premium market multiples. The product anchor, OFSS stands out because they sell licenses and platforms, not human hours. By building the core platforms that banks run on, they simply integrate AI to make their software stickier, completely insulating themselves from the service-level disruption. The high-risk and transitional players, Wipro, Tech Mahindra, LTI, and Infosys. Wipro is trapped in a multi-year turnaround, struggling with execution consistency, which results in the lowest ROE of the large caps. Tech Mahindra carries massive sector concentration risk, heavily tied to a global telecom sector that is currently slashing capital expenditure. LTI faces severe margin sensitivity as it tries to expand its digital footprint under heavy pricing pressure. Infosys is heavily exposed to legacy banking infrastructure, the exact routine maintenance work that clients are desperate to automate away. The bottom line, the days of blindly buying the Nifty IT index are over. You must pick the companies that own the platforms, or the companies fast enough to build them. Welcome to the conclusion, our definitive matrix for AI adoption and strategic positioning. This grid separates the future market leaders from the companies carrying heavy structural risk. Let's break down exactly who is ready for the AI revolution. First, let's look at the likely winners. TCS and Infosys both display high AI readiness. They have the massive capital, scale, and aggressive internal strategies required to dominate this new landscape. HCL Tech sits right next to them with high mod readiness, solidifying its status as a likely winner. Next are our structural and emerging winners. OFSS stands out with high readiness and is an absolute structural winner. Because they own the core software platforms, AI integration only makes their products stronger. Among the agile mid-caps, Persistent shows high readiness, cementing its status as an emerging winner. Coforge, displaying mod-high readiness, is also positioned as a highly capable emerging winner. Now we enter the transitional zone. These are companies actively trying to pivot, but facing significant friction. LTIMindtree shows mod-high readiness, but remains in a transitional status. Wipro and Infosys are lagging slightly with only moderate I readiness, placing both squarely in the transitional category. They have a lot of heavy lifting to do to catch up to the top tier. Finally, we have the danger zone. Tech M or Tech Mahindra is the most vulnerable on our grid. They show mod-low readiness and are the only firm slapped with a direct risk status. The ultimate takeaway for your portfolio: AI readiness dictates survival. If an IT company is stuck in transition or carrying a risk status, the market will not be forgiving. To wrap up, the days of throwing thousands of cheap human hours at a tech problem are over. The future of Indian IT belongs to those who own the AI platforms. Thank you for joining FinTickAI for this strategic breakdown. Please note that this report is for educational purposes only and does not constitute investment advisory services. Always manage your market risks,